Welcome to this latest DW Business Special. I'm Christy Platson in Berlin. Today we're looking at the euro's weak performance against the dollar. For the first time in 20 years, 1 euro is now worth just $1. That's also known as parity, which means the exchange rate is 1 to 1. Now, the euro has been under pressure for some time now. Since the beginning of the year, it has lost 13 US cents in value. The war in Ukraine and dependence on Russian gas are hitting the currency, as is monetary policy. Now, euro-dollar parity means Eurozone exports to the US are cheaper, a possible silver lining for export-oriented countries like Germany. But US goods are also more expensive for Europeans to import. For businesses, this means passing those costs on to customers who are already struggling to keep up with high consumer prices. Well, joining me at my small desk to talk about this is Cassandra Sunt from the Business Desk. Thank you for being with us. We also have Carsten Brzezinski on the line. He's chief economist at ING Germany. Hi, Carsten. Thank you both for joining me. I want to get to Carsten in a moment, but first to start with Cassandra. Now, Cassandra, I know that you have ties to the States. How is this currency situation affecting you?
This is obviously a really small story, but for me personally, I went to university in the U.S., and so I have student loans that are due in American dollars, and I've noticed that number has started to tick down, how many dollars I can buy for my euros, and I actually went back and looked what exactly is going on, and in June 2020, I could get about $221 for 200 euros, and now it's 200 for 200. And of course, sure. I don't expect any sad violin music to play for me necessarily. Sure. I will be okay with losing those $10 per month. I, like a lot of Europeans, are much more concerned about rising food prices and this looming energy crisis we have coming. Okay, right, but it's a great example that euros are getting weaker if you're needing to pay for things in dollars. Mm-hmm. So now Carsten, turning to you for a bit of a European perspective, what about yourself or people that you know? Are you, I don't know, doubting about taking that U.S. road trip this summer? What can you tell us?
Well, I'm too old to still have to pay back my U.S. student loan, but it obviously is extremely expensive now for tourists going to the U.S. And on the other hand, everything, like you said at the beginning, everything that we import, not only from the U.S., but also everything that we import, which is simply invoiced in U.S. dollars, will become even more expensive. And you talked about the energy crisis. Now, in which currency is oil, gas, and all other commodities invoiced in US dollars? So this energy commodity bill for Europeans will increase even further.
Right. Great point, Carsten. I mean, what we're hearing from both of you is that a weak euro is a major headache for Europeans. But as you just talking about tourism, Americans or anyone with U.S. dollars, their cash is going to go farther now in Europe than it has in a while. So any of those lucky souls who have managed to brave pandemic restrictions, air travel chaos, and are still able to make Eurotrip 2022, they're ready to splash out. Let's take a look.
It's great. The parity makes it easy for us, and our money goes a lot further now.
It's cheaper to come here and buy stuff, so it's better to come here, I guess.
I'm very excited that our American dollar is so strong just when I'm coming to Europe.
It definitely encourages us to spend. It's like it's on sale here, so.
I think the dollar and euro being together at the same amount is great for Americans. Our dollar is buying us more.
It seemed like the buying power didn't really affect me too much. We were actually able to purchase everything in advance.
All right, I want to go to Carsten on this now. So we just heard a few different opinions on the situation. Euro is cheap. We also heard, though, from Cassandra that Eurozone inflation at a record high right now. Consumer prices were up 8.6% in June compared to a year ago. Carsten, are dollar holders really getting such a good deal right now here in Europe?
Well, inflation in Europe is still somewhat lower than in the US. So you could argue with this weak euro, US dollar holders will get a better bargain in Europe these days. Well, if you then deduct the cost for traveling to Europe. But the other thing is, what we normally learn from textbooks is that European exporters benefit from a weak currency. So German car makers, for example, exporting their cars to the US or other European stuff. Which is true in theory, but I think currently, given that there are so many constraints in supply chains, in deliveries, in additional costs for producers, I really think that the disadvantages of a weak currency, that is higher inflation, higher imported inflation, clearly outweighs any benefits that we had in the past from a weaker currency, namely that it was supporting exports.
All right, this is the exact next point I want to talk about with Cassandra. We just heard it from Karsten, that we're seeing these higher costs. It's going to cost more for European businesses to import things that are priced in dollars. Crucially, a lot of very important commodities like oil, for example, are priced in dollars. The importers are probably going to have to pass these costs on to consumers. We know prices are already going up. Are they going to go up even further now?
Well, unfortunately, there's really no sign that things are about to get cheaper, right? Since the beginning of the year, we've seen inflation consistently above 5%, and it's been trending upwards. The current inflation rate, like we discussed, is at 8.6%. So let's say, for example, in this imaginary world, next month inflation rate was cut in half. That puts us at 4.3%. Nice. That would be nice, but that's still an inflation rate of 4.3%, which is double what the ECB, the European Central Bank's goal is. And so even if viewers are hearing things like the inflation rate is slowing, unfortunately, that just means things are getting more expensive at a slower rate. So all in all, it's really not a great outlook for consumers at the moment.
Okay, interesting. Karsten, I'm curious if you have any thoughts about what Cassandra said or about, the prospect of prices going up in general.
No, that was very well explained. So the student loan clearly pays off. So I think this is really the issue here. So inflation is going to stay high, even if headline inflation numbers were to come down, which I don't expect actually in the shorter run. Because I think that producers of goods, but also producers of services, will still try to put some price markups into the economy. Just think of the hospitality services, think of other services, leisure, culture. So all these sectors that were hit the most by the pandemic, by the lockdowns, they will try to charge price markups. So thereby, in no way will we see things actually getting cheaper again. We will see inflation coming down, but as Cassandra nicely explained, inflation coming down still means that stuff, goods, services are getting more expensive, only at a slower pace.
Okay, well, not exactly what I want to hear, Karsten, but I believe you. So I want to talk about how this is going to develop some more in a minute. But first, let's take a look back at how we got here in the first place. This parity situation has been quite a long time in the making, in fact. I mean, the last time the dollar and the euro were at par was in December 2002. That's right before the euro turned 3. Since then, the euro has held its own quite well against the dollar. In December 2007, 10 euros could buy you $14 and change. The two currencies reached their highest difference during the financial crunch of 2008. At one point, 10 euros could buy you almost $16. Now they stand 1-to-1. 10 euros gets you just around $10. So, Cassandra, to you again. Shortly after the euro was introduced, currency dealers had nicknamed it the toilet currency because of how quickly it was going down against the greenback. Right. How did the euro make such a comeback after that? Right.
The idea was it was going to keep going down and down and down. That nickname, I think it's really, the euro has proven that nickname wrong, in my opinion. This was a currency at the time that was part of a new experiment, the shared currency across many countries. And since that time where it first reached parity in 2002, we saw it bounce back just a few years later, 6 years later, in fact, to 16 euros to $10. Some research that I was doing at the time, when they were talking about parity at the moment, to use a German word, there was a little bit of Schadenfreude, I think, coming from some of these writers in English, exactly. Yeah. And since then, there's been a lot that's changed. So when we reached parity, there was economic decline in Europe, while the U.S. was rising. I looked at some statistics at the time. The U.S. was growing 7 times faster than Europe in this kind of moment around 2002. And that was led by a big decline in Europe's biggest economy, which at the time and still is Germany. Germany was still dealing with the ramifications of reunification, kind of investing in these 16 million people that had rejoined Germany at the time. So there was a little bit of a slowdown in the German economy. But in this moment, 7 years before the financial crisis, in that 7 years leading up to the financial crisis, I should say, German exports rose 76%. Wow. And that was a big part of the story of how Europe kind of bounced back. And there are a lot of factors at play here, but that one really stuck out at me because, like we kind of were already discussing, this could be a silver lining. This could be a moment for exporters to get a little bit of a boost. And that in turn, chicken and egg, what will we see first? But that could be a moment for the euro to start to turn around.
Okay, yeah, interesting point. Now, hopping back to July 2022, where we are now, Carsten, going to you. I mean, in some ways, the story of the weak euro is more of an energy story than it is a currency story. We know that the dip came after gas flows through Russia's Nord Stream 1 pipeline were shut off for maintenance. That's, of course, the main pipeline providing gas to Germany. Can you talk to me, how are energy and currency related in this situation?
Well, here I think energy and currency are related as such that currency traders of financial markets expect the energy crisis, higher energy prices, to really dent economic growth. So we are looking into some kind of recession in the European economy in fall and in winter. How mild, how severe it will be clearly depends on whether or not we will get a full stop of Russian gas going to Germany and other European countries. But this is clearly so it is the energy story and the impact that the energy story has on economic development. Because when you look at, you mentioned we were at 122 last summer. And since then, what has happened? Since then, we've seen that there is monetary policy differences. So the US central bank, the Fed, already starting to hike interest rates. But then we have the war. And since the war started, we have uncertainty in Europe. Everyone knows that Europe is the weakest spot currently in the global economy, suffering from higher energy and commodity prices, suffering from uncertainty. And these factors have really made that people and traders, investors have withdrawn their investments from Europe. And this means we're going to have this falling in currency.
Okay, so what I'm hearing now from Carsten, from Cassandra, is that this energy crisis, also other factors, are weighing majorly on the economy here and consequently also on its currency. Now, here in Germany, we know that the price of oil and gas have continued to drive up consumer prices in June. This has been a major pain point for the European Central Bank, whose whole mandate, of course, is price stability. Now, obviously, they can't control the war in Ukraine, disrupting energy markets, but that doesn't really get them off the hook, does it, Cassandra?
No, it doesn't.
So I want to talk to you about that in a second. Also hear from Carsten, but first let's hear what ECB President Christine Lagarde had to say.
Given its energy dependence, the euro area is experiencing these shocks acutely. The current level of food and industrial goods inflation have not been seen since the mid-80s. And the increase in the relative price of energy in recent months is much higher than the individual spikes that occurred in the 70s.
Okay, well, Cassandra, we just heard from the president of the ECB. Now, we just spoke with Carsten about how this currency story is also an energy story, but it's also a story about interest rates. We know that the U.S. Federal Reserve has been more aggressive about raising interest rates than the ECB has been, and this is increasing confidence in the U.S. economy and consequently in the U.S. dollar as well. Now, with this development, with parity, arriving this week, euro dollar, the ECB is meeting for their next monthly meeting next week. What do you think they'll be talking about? What could come out of that?
I think they're clearly under pressure. Last month there was an ECB meeting as well, and there was the signal that they're now authorized to maybe do something about interest rates. And now next Thursday, we're going to be seeing this meeting finally happening. I was looking back, I was curious because we've read a little bit about what the Fed has done in terms of interest rates. I was like, what was the interest rates over the past few years? And it's a decade, basically a flat line over the last 6 years, but they haven't gone up for a decade. It's like a slight decline, bunny hill, flat, right? Mm-hmm. So they're going to be under a ton of pressure here. And as I was starting to get read into the story and get an understanding of what we're going to be looking for, I read this Bloomberg survey of 28 economists, and 22 of them actually think that even if the ECB acts, they've acted too late, because as we've seen since the beginning of the year, the Fed has been much more aggressive. So the ECB, generally more conservative. I think the pressure is going to be on Thursday, especially after this parity news this week, for them to take some concrete action to reassure their member states.
Well, as I said in our episode about rising interest rates, the ECB does somehow have my sympathies. They've got a lot of factors to keep control of right now. Carsten, do you have any thoughts on this? Anything to add to what Cassandra said about the ECB interest rates? Anything?
Definitely, I think the dilemma or the problem for the ECB is nothing they can do will produce more energy and will make it cheaper, or will make the war stop, or will produce more microchips. At the same time, they know if they start hiking interest rates too sharply and too aggressively, they would cool down the demand side of the economy. So they would actually do even more harm to the economy. And it's also not in the interest of the ECB. So it's really a balancing act. They have reacted too late. When you look at the other central banks, we currently talk about rate hikes by 75 basis points, by 100 basis points, while the ECB is looking at doing 25 basis points next week. Would doing more stop the fall of the euro? For a couple of hours, maybe for a couple of days. But what the ECB would have to do if it wanted to stop really the fall of the euro, they would have to say, yes, we're going to hike aggressively, more aggressively than financial markets are currently thinking, and we're going to deliver even more rate hikes. And the latter is something they cannot tell financial markets because they know they are looking into a looming recession. We have a government crisis in Italy. We might have another debt crisis in the Eurozone. So the ECB really needs to treat extremely carefully 25 basis points next week, another rate hike in September, and that might probably be already it.
All right. Well, now, Carsten, to close us out in our talk here, you wrote recently that, quote, Europe's recovery is canceled. Now, since then, Nord Stream 1 has been shut off. The euro dropped below the dollar a little bit. So at this parity we're talking about. Now, what is your crystal ball showing you now for the next few months ahead as we get into autumn, winter? Who is canceled next?
Well, it's not going to be canceled next. We're going to see a recession, and an economist defines a recession as 2 consecutive quarters with economic contraction. This is what we're looking at right now. We have these high inflation numbers, which are going to dent private consumption, which are an increasing burden on profit margins from corporates. So this alone is already pushing down the Eurozone economy into a mild recession. If we were to see this additional energy supply disruptions, read a stop of Russian energy floating to Europe, we would not only talk about a mild winter recession, or we talk about a severe recession in the Eurozone. So it's not only recovery canceled, it is recovery canceled, welcome recession.
All right, Carsten, thank you so much. We're going to have to leave it there. It's been a nice chat with both of you, but obviously a very sobering takeaway that we've ended with here. That's all we have for you this week from our small desk. We'll be back with another DW Business Special for you next week. I want to thank again Carsten Brzeski from ING Germany for joining us. Also my colleague Cassandra Sant from the DW Business Desk. From us and from the whole team here in Berlin, thank you so much for watching the show. We'll see you next week.